This is the 4 ways to invest in multifamily real estate. The 4 ways to invest in multifamily real estate. Way number one is online platforms, REITs. This is like investing in a stock, right? You're going to be buying a share in a multifamily deal. You're going to be buying, it's basically a paper stock in a multifamily corporation that owns the actual real estate. Number two is you're going to buy the property yourself. Number three is going to be LP. That's your limited partnership. That's where you are a limited partner in a deal when you're receiving all of the benefits of real estate, but you're not the main operator of the real estate, right? And then way number four is your GP, your general partner. That's when you're active. That's when you're the operator of the multifamily real estate deal. You're operating it for the LPs, right?
So just to talk about method number one, right, which we don't really recommend, but there are some benefits, right? So when we talk about, the online platforms, the REITs, right? The REITs, the real estate investment trusts, you can go onto your brokerage, your account right now, right? Your Charles Schwab, your Ameritrade. You can go on there and search for these REITs, these real estate investment trusts. And it's a way to own real estate, right? They go out and they buy assets. And they're very easy to access, right? You can get in there and you can buy and sell shares for a lot of them whenever you want. They're fully passive, right? You buy these things, and that's it. You can walk away and just let them go. They're liquid. You can be in and out of them, multiple times per day if you really wanted to. And the required minimum investments for these things are usually a lot lower. So you can get in for the price of the REIT, right? You could buy one share theoretically. And then there's also the online platforms, right? The Fundrises, Ground Floor, Diversifund. These are a little different, whereas they're not a REIT. You can't really trade them. Most of them you can't trade in and out. Some of them I think you can. But once again, the required minimum investments for these are usually very low as well, maybe a couple $100 to get started. But these are not what we recommend, but there are, as you can see, some benefits for them.
Right.
Now some of the bad, right? So when we're talking returns, right? When we're looking at multifamily, we typically like to target 15% returns or greater. When you look at a lot of the biggest REITs, over the past 2 decades, right, they weren't really able to match that level of performance, right? Now, hey, 9, 10, or 11% is not terrible. It's not bad, by any sake of the imagination. But overall, when we target these investments, we're shooting for a higher number. Online platforms are kind of the same story. There's a lot on those online platforms that are lower rates of return. I'm not saying you can't find a 15, 18% return on those platforms, but they're a lot fewer and far between. And then some more of the downside, right, with the REITs and the online platforms. A lot of the times the upside is limited on these investment vehicles, right? A lot of times they target yields and kind of a preferred return payout, but you don't get the upside of the property appreciation. That's captured by the fund and the fund managers. As an investor in most of the platforms, you also don't get the depreciation for tax benefits, right? You're missing out on half of the power of these real estate investments on not having to pay taxes or deferring taxes. And then as you invest in some of these larger funds, you're not able to go ahead and pick the exact property that you want to invest in or the exact team. A lot of these funds are huge. They've got lots of people working for them, picking properties. They're very diversified. So you won't have that selectivity amongst, picking what you actually want to invest in.
The second way to buy a multifamily property is to buy the property yourself. What are the benefits of buying the property yourself? You get the full upside of the property, full upside of the potential that you create at the property. You also get the full depreciation benefits and the control of the property. So what is depreciation again? It's a way for the IRS allow you to depreciate the property for the wear and tear that the property is receiving from the tenants. And this shields the income that you're receiving. This will shield it, right? So like what are some of the negatives, right? So with full control comes full responsibility. You will potentially need to manage the property if it's not large enough to support dedicated property management. So that was a big pain point for me, I was buying these duplexes and these triplexes and these quads, but they weren't large enough to hire dedicated property management. So I took over those duties. So I was dealing with the person when I was renting out the place. I was dealing with the resident while there was issues at the apartment, if there was a leaky toilet or there was hair in the sink. It didn't have property management because the property wasn't generating enough income to pay for the property and then pay dividends to me and my investors. So, and then some of these larger properties, they support dedicated property management, are very expensive, like 5 and 10 and 50 millions and up, right? What is that? Actually, what does that mean, Brian?
Yeah, so I don't know about you guys, right? But dedicating several $1 million to one property investment, that's a lot of eggs in one basket, right? So larger properties that can support that dedicated management, they're very expensive, right? So if you don't want to be answering those calls, right, you're going to want one of these larger properties, but it's hard to tackle it yourself unless you're willing to commit a very large amount of your own capital to buy the property yourself.
Totally agree. These big deals are bought as teams. These big deals are bought as groups of people. Why are they bought as groups of people? Because you can distribute the risk among a number of investors, right? You can distribute the risk and you can distribute the benefit. So what if there was a way to be a full owner in the biggest and best properties without having to do it all on your own?
Sounds interesting to me.
I know it does, right? The way you do that is through multifamily real estate syndications, right? So this allows you to invest as a collective, as a group of people, right? As a group of people and buy a multifamily property together. Some of the biggest and best apartments. These syndications are organized and run by GPs, which are the general partners, with LPs, the limited partners that invest passively. They just bring capital to the table, and then the general partners will operate the deal. They'll hire their property management. They'll do asset management. What is asset management? That's managing the big picture vision for the property. Like, we're going to renovate 10 units a month for the next 12 months. We're going to put a new roof on the property, right? As an asset manager, as the GP, as the operator of the property, you're going to make those decisions. Like, we're going to spend, we're going to spend $1 million on renovating the exterior of the property, right? So multifamily real estate syndications have both GP and LP investors. So to invest in a syndication as an LP, what are the upsides, right? You get the full upside of the property performance. You get all of the depreciation benefits, right? So you're going to be receiving cash flow, and then you're going to get depreciation, which is then going to shield that cash flow. And then sometimes even show a negative on your tax return, when in reality you receive cash flow all year long. The control of the property is in the hands of the GP, who represent the best interests of the LPs, right? So the GPs are people you know, like, and trust, that are good business people, that are going to perform for you. They're going to generate returns for you. You get to select the GPs you work with on the properties and the locations of the properties you want to go in and invest in on. Investing is fully passive. Do your due diligence up front on the property and the GP team. You know, once that's like you've made that commitment, it's fully passive. You write your check and then you walk away, and then you're receiving your cash flow, right? Whether it's monthly or quarterly. So some of the downsides is a portion of the profits go to support the general partner's work, right? So they get paid for the work that they're doing. So you're sharing in some of those profits. But the deals that I see are usually 70% to the passive investors. So they're getting 70% of the deal while the general partner is only getting 30% of the deal. The required minimum investment is often usually high. You know, for REITs, you could probably buy some of these REITs for $200, $300, $400, $500 a share. Whereas a multifamily deal, typically the minimum investment amount is going to be $50,000, and the investment is illiquid. Like for the REITs, you can trade in and out of those investments every single day. Whereas multifamily, once you've made that commitment, you're committed to that investment for the life of that investment, which is typically 5, 6, 7 years. So investing in a syndication as an LP is a high return, fully passive investing, right? The third way, or the fourth way actually, to invest in a syndication as part of a team is when you're the GP. That's when you're the operator. That's when you're the general partner, right? So what are the upsides of being the GP? You get the full upside of the property performance and the potential of it, right? You also get the depreciation benefits. You get full control of the property. You know, you're the one making the active decisions at the property. You're deciding what units to renovate. You're managing. You're working with the property manager who's on site all day, right? You're working with them on the business plan for that property. The only limit to the property size you can acquire is the amount of investors you have. So you can go after, you know, $5 million properties or $100 million properties. It's just going to depend upon how much work are you going to do to go get investors. And when you're the general partner, right, there's no required minimum investment from a dollar standpoint, right? Like you don't have to bring any capital to the table. Now, most passive investors will want the general partner to bring money to the table, but it's not required. What's required is for you to show up and to produce returns for your limited partners, for you to go find the good deals, for you to make the relationships with the brokers, for you to put together the whole team to be able to go buy these properties to produce the result that we all want. And that's cash flow, that's value creation, that's equity, splitting the equity, right? So what are some of the downsides of the GP team, right? So you're not fully passive. You got to work. You're going to have to put work in, building relationships, making sure the property manager is doing their job, making sure the vendors you bring on site are doing their job, right? And then again, the investment is illiquid and will require the participants to wait until the end of the hold period. So you have to be committed for the long term. Like you're going to be committed for 5, 6, 7 years, right?
Yeah, GP and LP investments, a lot of good stuff there. And I mean, if you're kind of thinking about becoming a GP, one of the really great things to do is maybe just start as an LP, right? Go ahead and get invested in one of these deals, start to learn, start to see how it unfolds, right? And then as you kind of get going and build up your skill set, right? Then you can get into a GP. So you can almost kind of scale in.
Totally agree with that. And it gets you comfortable with the paperwork. It gets you comfortable with the rhythm of one of these investments, right? Totally agree. So those are the 4 ways to invest in a multifamily real estate deal. Way number 1 is through a REIT. Way number 2 is to do it all on your own. And way number 3 is to invest in part of a real estate syndication as a limited partner. And way number 4 is to be the general partner in a real estate syndication.